Here's a trade to get your week started. We're looking at EOG Resources. Obviously, you see resources at the end of the name. The first thing you should think is oil and gas or materials of some sort. Now, EOG itself is an oil and gas company. And as you see in this 10-year chart since 2002, stock has basically made a parabolic rise from 20 bucks all the way up to 140. And it's looking now like it might be another good time to buy. So it just had its earnings back on, let's see, November 6th, so puts us back on to Tuesday. And the earnings were, they were so-so. But, as you know, as a technician, I really don't care about earnings that much. So what I care is the supply and demand picture and the technical side of things. And what I am seeing is that it's very close, and even briefly, it's very close to making new multi-year highs. So new highs since, let's see, 2008. Okay, so I zoom into this chart. Actually, we'll just come into a 2-year chart, and we'll just draw our line right across the top. You see that we had this intermediate burst above this 120 resistance level. We had a small burst right here, which was then quickly killed by the earnings announcement, it looks like. Or maybe the hype just ended by the end of the day and the rest of the market dropped down. But as you see, it broke above this level. And if we do a simple trend line on the bottom here, we can see that it almost looks like an inverse head and shoulders pattern where we have one shoulder here, one shoulder here. Or if you don't want to call it that, we can call it some sort of triangle. Now, this gives us a target at this point of just about, this is a pretty high target. So I'm going to make some adjustments. It gives us a target all the way up at 175. Do I think it's going to get there? Well, let's see, 175. That looks a little, that's going to be a little tough because this level right here around 142, that's the all-time high. So that's obviously going to be a resistance level. So what can we do? We could say, okay, we'll buy it when it eventually breaks above 120, and we'll maybe sell a little bit, or let's say we buy 100 shares. So 100 shares, 14,000 bucks, and it gets close to here. What do? We still expect it to make new highs. So what do? We sell a call option on it, or we buy a put option on it. Just something to hedge us in an intermediate time frame. But do I really think it's going to get this high? Not yet, but we're going to see something happen in the probably next few months, and that is we're very late in the bull market, and late into bull markets generally inflation-sensitive stocks will outperform non-inflationary sensitive stocks. So I look at EOG and I see that it has very large natural gas reserves, and then I look at a chart of like natural gas, we'll just use UNG right here, and I see that it's made a pretty nice, let's move this, it's made a pretty nice reversal since it split. So like simple 9-month chart, I think I actually bought it down here around 16 bucks, but it's definitely going up. Maybe a futures chart would be a little more appropriate. So futures, there we go, natural gas. If we take a look at this, you can see just a simple fuse chart. We did have a pretty nice reversal down here, and it actually looks like a head and shoulders reversal when it broke above 280, and it's still going up. So major reversal pattern, natural gas is going up. It's been outperforming crude oil pretty much the entire year, so like UNG over oil, you see this rising line. So EOG, since they have a large natural gas position, that's a good thing. But like I said, that's the strategy that we're going to do. Buy once it gets above 120 and give it enough room, like wait for it to close, and also make sure to use a time stop. So let's just say the market's in a correction, and that's not fun. So we see this like this trend line here. We can maybe set our stop right below the 30 and 50-day moving averages, so that puts us at around $110 stop price or slightly above that. So we buy at 120, we have a $10 risk. We expect to get all the way up to 175. So good risk reward ratio, but like I said, use a time stop. So for instance, we'll say exit if not profitable in, let's just say, pick a number, 10 days, and 10 trading days, so 2 weeks. Why do I do this? Because if experience teaches me anything, it has taught me that if I buy a stock expecting it to break out to the upside, just flounders around sideways, normally means I'm wrong. Normally means that it's going to flounder around sideways, continue to do that, and then flounder around the opposite direction that I want it to go. So put a time stop on it. Besides that, normal stop is going to be below the moving averages, and that is how we are going to play it. All right. Happy trading, and hopefully we'll come back in a couple months and see this at 175, maybe like 8 months or something. But just remember too, if it goes all the way to 175, that probably means that gas prices are going to go up a lot too. All right, happy trading.